The biggest bank collapse since the 2008 financial crisis.
Silicon Valley Bank, the powerhouse tech lender fueling the tech industry's growth for years, recently made headlines for all the wrong reasons. The sudden collapse of this industry giant left many scratching their heads, wondering how such a massive institution could fail so spectacularly. Some analysts pointed fingers at the Trump-era regulations, which had relaxed the rules around lending and allowed Silicon Valley Bank to take on more significant risks. Others blamed the bank's leadership, suggesting that poor decision-making at the top may have been the root cause of the collapse. And then some attributed it all to the sharp increase in interest rates, which left Silicon Valley Bank reeling. Whatever the cause, there's no denying that the fall of Silicon Valley Bank has sent shockwaves through the financial world. In this video, you will discover how Silicon Valley became a powerhouse and what led to its eventual fall. The explosive growth era.
The business, SVB Capital, all performed exceptionally in the first quarter, and that drove our heavy EPS beat.
Once upon a time in Silicon Valley Bank, deposits began to soar to unprecedented heights. From 2018 to 2021, they tripled in size, leaving the bank with more cash than it knew what to do with. But with startups losing steam in the pandemic's wake, the bank had to get creative with putting all that dough to use. So it took a page out of the old playbook and invested in long-dated government bonds and mortgage-backed securities. With a balance sheet of $212 billion, SVB was a titan of the banking industry. But it wasn't content to rest on its laurels. Instead, it put $120 billion into its investment book, with $91 billion tied up in mortgage-backed securities, MBS, and $29 billion in T-bonds. Now, for those who aren't financial whizzes, an MBS is essentially a pool of mortgages that transfers credit risk from a primary lender to an investment bank. Compared to treasuries, they're less liquid, but that didn't stop SVB from betting big on them, with a duration of 10 years. A little shake.
But if you really look at the fundamentals of so many businesses, it's really just the valuation is coming down a little bit. And we also see that almost in every situation when rates start to pick up, you start to see the highest growth stocks tend to pull back. So I don't think we should be that surprised we're sitting here right now.
At first, everything was going well, with interest rates on these investments tracking the market. But then disaster struck. The Federal Reserve raised interest rates, and the value of the bonds plummeted faster than a roller coaster ride. It's like having a precious bond worth $1,000 with an 8% coupon. Suddenly, the market yield increases to 10%, which means your bond is only worth $800. Why hold on to it when you can earn 10% elsewhere? Every bondholder feels the same way and starts selling, which puts even more pressure on the price. Eventually, the bond price drops to $800, where the yield is 10% and you lose $200. Luckily, this loss is temporary and notional if you hold onto the bond until maturity. Nonetheless, it's a tough pill to swallow, especially for a bank with a balance sheet size of $212 billion. The Avalanche.
So a few hours later, I called the investor and I said, hey, what was this email about? He was out of breath, like he had just run a marathon. And he said, take your money out of SVB, go into your account, take your money out as soon as possible.
Suddenly, the bank found itself facing a huge problem. Investors wanted their deposits back, and these bonds had to be sold at a loss to see the cash to repay the borrower. It was a domino effect, with more and more sales following, and SVB took a massive hit. The bank had grown its HTM book from $14 billion to $99 billion, with an asset-liability mismatch that exposed it to duration risk. To find a way out, it sold $20 billion of securities to Goldman Sachs in an OTC sale at a loss of $2 billion. The contagion effect had begun, and it was a race against time to salvage what they could. SVB found itself in a precarious situation when it began selling off its assets and had to confront its losses. Things worsened when Moody's, the credit rating agency, threatened to downgrade the bank's credit rating, sending investors into a frenzy. As the bond market continued to deteriorate, SVB was forced to take action to strengthen its position by raising capital. However, investors saw this move as a red flag, compounding the bank's problems. The situation was growing increasingly dire for SVB. SVB's over-reliance on corporate and venture capital funding proved to be a precarious decision. It's like relying on a parasol in the middle of a storm instead of a safer alternative. SVB's deposit base consisted of 99% corporate deposits, known to be fickle and tend to flee at the first sign of trouble. To make matters worse, only 7% of these deposits were insured, making it a double whammy. SVB also had a high percentage of loans and securities relative to its deposits, making it a high-risk profile bank. This was akin to walking on thin ice, which gave way when interest rates rose. Depositors started pulling out their money, and mandatory asset sales had to occur, leading to a complete bank meltdown. Who do we blame? Senator Bernie Sanders has pointed fingers at a 2018 law, supported by Congress and signed by former President Donald Trump, for exacerbating the issues leading up to SVB's recent financial troubles. The law undid some credit requirements imposed under the Dodd-Frank banking legislation introduced after the 2008 banking crisis. The Dodd-Frank Act requires banks with at least $50 billion in assets to undergo an annual Federal Reserve stress test and maintain certain capital levels and plans for a living will if they failed. However, SVB CEO Greg Becker argued that the $50 billion threshold was unnecessary and that the bank, like other mid-sized or regional banks, did not present systematic risks. Despite concerns raised by the non-partisan Congressional Budget Office, the law passed, and Trump praised it as a significant step towards fixing Dodd-Frank, which he called a job killer. The situation at SVB also highlights the importance of risk management in the financial industry. A chief risk officer is critical in ensuring that a bank's risk exposure is almost non-existent and that potential risks are identified and addressed before they become significant. The Federal Reserve is reportedly investigating the bank's CRO situation, suggesting that the regulator is taking the matter seriously. The lack of a CRO at SVB for several months is a concerning situation, especially given the bank's risky profile and the increasing frequency of risk committee meetings before the collapse. Additionally, the early shareholder lawsuits against SVB suggest there may have been issues with transparency and disclosure of risks. Investors have a right to know about the risks a bank takes with their money and how those risks are managed. Any lack of transparency or disclosure can erode investor confidence and potentially lead to legal action. Hope for investors. In a glimmer of hope for the depositors of SVB, US regulators have devised a plan to ensure that they all get their money back. The Fed has announced that it will create a brand new Bank Term Funding Program, BTFP, that will provide loans of up to 1 year to all the institutions affected by the collapse of SVB. And that's not all. The loans will be backed by US Treasuries and MBS and will be valued at par regardless of the changes in interest rates. So if you are one of the many depositors who lost their hard-earned money in the fall of SVB, there's finally some good news for you. The new plan is a lifeline for those who were left in the lurch when SVB collapsed. And it's a testament to the government's commitment to ensuring the financial system's stability. There we have it. Major vital indicators of the wild run by Silicon Valley Bank and how it collapsed within days. Why do you think the bank collapsed? Lack of qualified personnel at the helm of affairs, or a government policy that put the organization in a difficult situation? Let us know in the comments. And don't forget to like, share, and subscribe.